There's been a bit of a gold rush lately with people physically lining up for hours to buy physical gold. Now, gold has historically been flagged as a bit of a safe haven, essentially. And with Wayne mentioning that key theme around uncertainty and inflation and everything like that in the media at the moment, the headlines, what is really driving this investor behavior? Is it purely that uncertainty that's around in the market at the moment? And how do you evaluate these sort of prices or where gold is at the moment?
Yeah, like look very topical. I've seen those lines outside Martin Place in Sydney with people lining up. I don't quite know why they would be lining up, but there's other ways of getting exposure to it. But look, just as I guess as a backstory, uh, since the start of 2020, gold price has risen by around I think 170%.
Mm.
And if that's not strong enough, it's pretty much doubled since Feb 2024, compared to a 20% gain in the preceding 5 years. And now you understand because of these movements why gold is, it's a topic of every CIO call and media headlines and barbecue conversations because of the returns that are being seen by everyone. And this is not a normal behavior for a defensive asset, as you say, in terms of a safe haven asset. Gold has outpaced most major asset classes. And the drivers behind it aren't just the usual suspects like inflation going up. Gold provides a hedge for inflation or interest rate expectations. These short-term factors matter, but I think there's something deeper that's been happening beneath the surface in the gold market. You've got the persistent geopolitical uncertainty, and you've got a once in a generation now shift in central banks around the world, which have typically invested their reserves in US dollars, wanting to diversify away from US dollars because of the concerns that the US dollar is going to be devalued in the future because of the amount of debt that country has. So what they're doing is they're diversifying their holdings and adding gold to their reserves, as an insurance policy, if you like. And that's been the real big buyer in that gold market, if you like, from a structural perspective, because it's not just one or two central banks around the world buying gold, it's pretty much all of them that are doing that because they've had that such big exposure to US dollars, and that's probably not sort of the wisest thing to do now, given the way the US is looking from a fiscal perspective and from how much debt they have and their interest bill. So look, and from our perspective, we've got to sort of ask, does gold still matter in our portfolios? We've had gold in our portfolios since 2020.
Mm.
And look, it's up and down over the very long run. Returns for gold have been very modest. So if you go back a hundred years, gold averages about a 5% return per annum. So it's not great, not spectacular, nothing like we've seen. But where it gets interesting is that gold's value isn't really about the average return. It's what it does during the worst moments in the market. That's where the gold's contribution to the portfolio really shines in terms of gold performing well when recessions hit, gold performing well when there's geopolitical risks, or inflation, or people's confidence in central bankers decline. So that's where gold helps. Gold is volatile, and basically what you're trading off by having gold as a part of your assets is you're going to be getting slightly lower returns in very strong bull markets, and gold is going to lag other growth assets like equities, but you'll have a shallower drawdown when things go bad. So it's a good sort of insurance hedge to have in the portfolio during times of uncertainty. And as you said, this could be one of those times where in investors' minds that uncertainty needs to be dealt with.
Yeah, fair. I think Lonsec have had in there for a while, which we like and support, and it's helped our clients. I suppose the Lonsec conservative approach to protect that downside for us is key. But yeah, it's hard. Like if a share price doubles over, a share price earnings double over 10 years, well, the share price should also double over 10 years. But gold doesn't produce a yield or a rental return or something like that. So valuations can be hard. There's obviously been a lot of various articles that it's going to hit this figure or that figure or those kind of things. So I mean, not putting on the spot too much, but it's been the portfolio with the continued uncertainty. I'm assuming it's probably staying the portfolio for a little while, but maybe not on the expectation it's going to double again next year or two, but just purely as that protection hedge, Dan.
Yeah, look, you're absolutely right. It's impossible to value it. It doesn't have an income stream. It's just a commodity, but which has been regarded as a solid store of wealth for many years. So the conversation is now that it's done so well, what do you do with it? So then this is where you go back in terms of why do I have it in my portfolio? And it's basically one of the key characteristics of gold is that it is not correlated to the other assets that you hold in your portfolio. By way of what that means is that it doesn't behave in the same manner as everything else that you hold. So that really adds a really good diversification angle to your portfolio, because when that part of the portfolio does something, gold is likely to be doing something different. And the two central facts that we want to have protection against is that potential further devaluation of the US dollar, which is gold is priced in US dollars, and it's going to have implications for a lot of assets, and it's going to be positive for gold if the US dollar keeps declining. And the valuation front in terms of if you are selling your gold, what are you going to be buying instead of it? So if there is a left field shock event coming through the market, causes some sort of a sell-off in the market, and there's some really attractive growth assets that you can purchase at a much more attractive valuation at a cheaper price, then you could potentially use gold as a funding source, knowing that a lot of those risks that you wanted protection for by holding gold has already been priced into the valuations of some of the other assets. You can use that to rotate some funds away from gold and into those equity holdings. Or if there is a really good fiscal discipline in the US and they start coming up with a tangible plan of reducing their debt and paying their interest bill and reducing that interest bill, then you go to the conclusion that I don't need as much gold in my portfolio because that risk has been reduced significantly.